Does State Farm's $5 billion mask a trap? Evaluate State Farm's $5 billion payout and $4.6 billion rate cuts to optimize your enterprise risk and capture a 10% premium reduction. State Farm generated headlines by returning $5 billion to qualifying auto policyholders, yet treating this massive capital distribution as pure generosity overlooks the disciplined financial mechanics and underwriting recovery that made the payout possible across nationwide markets. The insurer produced a $1.5 billion underwriting gain in 2025, executing an impressive turnaround after enduring a painful $6.1 billion underwriting loss throughout 2024 as repair inflation and severe loss cost volatility battered carrier reserves. Total net income surged to $12.9 billion across group operations, supported by $111.6 billion of earned premium and $7 billion of investment earnings, proving that substantial operational improvements underpin the executive leadership's decision to return excess surplus. Property and casualty pre-tax operating profit reached $8.5 billion in 2025, completely reversing the previous year's $111 million operating loss and creating a legitimate, defensible accounting foundation for distributing surplus capital back to qualifying private passenger vehicle policyholders. You should look past headline optimism because insurance profitability deteriorates rapidly whenever catastrophic weather events, severe litigation trends, and rising auto replacement part expenses suddenly collide against established carrier balance sheets and annual pricing models. The carrier expanded its surplus net worth from $145.2 billion to $170 billion by year-end 2025, adding $24.8 billion in balance sheet equity that adequately absorbed the $5 billion distribution without compromising mandatory solvency requirements. While a $170 billion surplus allows State Farm to comfortably fund customer distributions today, one positive underwriting cycle should never be mistaken for permanent financial insulation against future cyclical claim spikes and sudden reinsurance price increases. The National Dividend Initiative covers over 49 million insured motor vehicles, yielding a calculated nationwide average payment of approximately $100 per vehicle to households holding qualifying private passenger auto policies during the applicable operating year. Individual dividend checks range between 4% and 10% of qualifying 2025 premium payments, meaning policyholders experience distinct financial outcomes based entirely on state-level underwriting performance and individual policy values rather than uniform flat-rate allocations. Mississippi drivers received over $70.5 million in aggregate relief, producing a regional average payout of approximately $124 per vehicle that illustrates how local claims performance dictates actual cash distributions far more than broad national averages. State Farm structured the distribution as distinct cash disbursements rather than policy credits, ensuring eligible drivers experience tangible liquidity rather than an invisible accounting adjustment tucked inside an upcoming billing cycle renewal statement. Policyholders cannot elect future premium offsets because separating cash payments from standard billing establishes direct psychological value, reminding consumers of mutual ownership advantages while maintaining operational clarity across diverse state regulatory reporting frameworks. Mississippi regulators highlighted that returning $70.5 million provides direct economic relief, but properly emphasized that long-term carrier solvency must always take priority over short-term distribution campaigns designed to appease cost-burdened vehicle owners. Eligibility rules differ locally, as Mississippi required an active policy on December 31, 2025, whereas national guidance qualified private passenger auto policies active at any point in 2025, subject to minimum administrative processing thresholds. National disbursements commenced in late July 2026 and rolled out in sequential waves across states, allowing administrative processing teams to manage operational volume while deliberately extending brand visibility and positive consumer engagement over months. The far more consequential financial development centers on State Farm executing auto rate reductions across 40 states, which is projected to generate approximately $4.6 billion in recurring annual premium savings for active policyholders. Average rate decreases reached roughly 10% across participating state markets, establishing recurring baseline affordability that provides deeper structural financial benefits to households than any single, non-recurring dividend check ever could over multiple years. A one-time payout delivers immediate cash liquidity, but sustainable rate cuts permanently reduce the cost of risk protection, making long-term premium trends the ultimate metric for assessing structural improvements in property and casualty underwriting. Management clarified that distributing dividends will not trigger future rate increases because the payout rewards past 2025 financial performance while prospective premium rates reflect expected claim frequency, severe weather risks, and forward repair costs. You need to calculate total insurance value by evaluating baseline annual premiums, deductible structures, claims responsiveness, and policy limits together, rather than allowing a single dividend check to distort objective carrier price comparisons. The payout serves as an aggressive retention tool during an era of unprecedented customer switching, allowing State Farm to remind policyholders that its mutual structure returns excess capital directly to consumers rather than external equity shareholders. Distributing cash reinforces mutual alignment right as price-sensitive drivers actively shop alternatives, providing State Farm a tangible competitive moat against publicly traded insurers that must prioritize Wall Street investor dividends and corporate share buybacks. Behavioral bias remains a genuine risk if drivers overvalue a $100 or $124 check while ignoring thousands of dollars in recurring annual insurance premiums that accumulate across continuous vehicle ownership and multi-car family policies. Returning $5 billion represents an explicit capital allocation choice, foregoing alternative investments in claims automation infrastructure, digital self-service platforms, expanded catastrophe reinsurance protection, or deeper regional rate reductions to preserve long-term competitiveness. Holding a $170 billion surplus provides considerable balance sheet safety, yet capital planning models must constantly treat severe catastrophe spikes and unexpected bodily injury litigation inflation as imminent operational threats rather distant statistical anomalies. Distributing capital signals that executive leadership maintains complete confidence in auto portfolio stability, but this public gesture inevitably establishes dangerous customer expectations for future windfalls whenever the carrier reports another profitable underwriting year. Insurers should establish transparent educational frameworks that clearly explain how loss ratios, regional accident frequency, repair supply chains, and investment yields directly influence policy pricing, converting routine checks into meaningful financial literacy tools. Management must establish rigorous balance sheet surplus floors and catastrophe stress testing benchmarks before approving future payouts, ensuring policyholder distributions remain disciplined operational results rather than recurring entitlements demanded by an expectant public market. Prioritizing the $4.6 billion in recurring rate savings over periodic capital distributions delivers superior consumer protection, anchoring long-term customer relationships on predictable pricing stability rather than episodic marketing-heavy cash disbursements across cyclical quarters. State insurance departments should mandate standardized dashboards showing why dividend percentages swing between 4% and 10%, clarifying the exact actuarial mechanics behind state-by-state variance and eliminating unnecessary consumer confusion regarding distinct check sizes. Disciplined consumers should conduct comprehensive multi-carrier premium audits following rate adjustments, factoring the temporary dividend into total cost calculations without abandoning normal due diligence regarding roadside coverage, endorsements, and customer claim satisfaction ratings. Moving $5 billion across 49 million insured vehicles creates massive operational exposure, requiring airtight data verification protocols to prevent fraudulent diversion, check forgery, digital account takeovers, and widespread consumer phishing attempts by bad actors. State Farm established dedicated payment portals for email-registered drivers while issuing physical paper checks to offline customers, creating practical distribution pathways that still demand aggressive public awareness campaigns to prevent widespread payment fraud. Dedicated customer support channels and clear administrative routing are essential to resolve missing disbursements quickly, ensuring that technical payment processing friction does not erode the brand loyalty the capital return was engineered to build. The transition from a $6.1 billion underwriting loss to a $1.5 billion gain proves insurance profitability remains inherently volatile, reinforcing that operational excellence requires multi-year underwriting consistency rather than celebrating single-year financial rebounds. Insurers face reputational backlash if customers mistake surplus payouts for proof that previous premium hikes were predatory, requiring executive teams to defend the vital distinction between historical capital accumulation and forward-looking actuarial rate setting. Long-term customer value depends on reliable claims handling, fair settlement practices, and balanced underwriting, meaning the true test of this distribution lies in how State Farm performs after policyholder checks are cashed. When evaluating corporate capital recycling and enterprise risk management frameworks, strategic insights from L-Impact Solutions emphasize that recurring cost containment consistently drives deeper institutional resilience and client loyalty than temporary liquidity distributions. The $5 billion distribution proves that mutual insurance mechanics can deliver meaningful tangible relief, yet consumers must remain vigilant about whether underlying carrier pricing structures remain competitive against rival regional property and casualty underwriters. Mississippi's $70.5 million payout demonstrates significant local impact, but policyholders must understand that regional loss frequency and state regulatory environments dictate whether future distributions remain actuarially feasible or entirely unsustainable over time. Staggering payments across multiple months allows operational teams to manage liquidity flows effectively, turning a massive logistics hurdle into an extended public relations showcase that highlights financial strength across competitive state markets. Rate cuts totaling $4.6 billion across 40 states will shape consumer household budgets far longer than temporary checks, underscoring why structural underwriting discipline represents the true foundation of sustainable consumer-first insurance operations nationwide. Corporate boards must balance policyholder returns against long-term capital preservation, ensuring surplus reserves remain sufficient to withstand multi-billion-dollar catastrophe years without necessitating emergency rate filings or abrupt market withdrawals. Clear communication regarding state eligibility rules prevents policyholder frustration, as slight variations between national guidelines and state-specific cutoff dates can inadvertently trigger customer churn if not handled with complete transparency. Providing cash instead of automatic policy renewal credits allows drivers to allocate funds independently, delivering immediate household utility while clearly distinguishing mutual profit sharing from standard statutory premium rate adjustments across operating territories. Comprehensive risk assessments published by L-Impact Solutions demonstrate that aligning capital distributions with strict solvency thresholds prevents carriers from compromising their core claims-paying capacity during sudden, severe macroeconomic or environmental downturns. You must evaluate your total multi-year insurance expenditures objectively, ensuring that a $100 dividend check does not distract you from identifying more cost-effective coverage options available across an evolving auto insurance marketplace. For more analyses, visit our consultancy website. Link in description below. Thank you.